All right. When it sends both of them, I'll count you down. Here we go. Three, two.
Do you have a friend who has a friend and you can't get rid of that friend, and your relationship with your friend depends on you being friends with the other person? I know the feeling, especially anyone who bought a home with an FHA loan. You wanted the home, and what comes with a home on an FHA loan? Monthly mortgage insurance premium. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. And tonight we are going to go over the right way to remove mortgage insurance premium on an FHA loan. If it's your first time tuning in, do me a huge favor, hit the subscribe or notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 o'clock, Tuesdays on Instagram, and we post content daily on TikTok and Instagram. So don't forget to follow us on our other platforms. And remember, this is an interactive channel, so ask a lot of questions. So the number one question all FHA home buyers ask their loan officer the moment they close escrow: when can I remove my mortgage insurance premium? Okay, so before we talk about removing it, we need to identify the two types of mortgage insurance on an FHA loan. Guys, also, if this video brings you any value, save this video and share this video. If you know somebody who has an FHA loan, share this video with them. If you know someone who's going to buy a home with an FHA loan, share this video with them, right? Give them the power to remove the mortgage insurance premium. So let's get back into it. FHA has two types of mortgage insurance premium. Of course, the number one, everyone knows about it. It's the monthly mortgage insurance premium that every time you make a mortgage payment, it includes that mortgage insurance premium. You can't pay it separate. It's included in your monthly mortgage payment. And the second type of mortgage insurance premium is the upfront. So on an FHA loan, there is upfront mortgage insurance premium. It's already rolled into the loan amount. You might have noticed it when you went to go sign your loan docs and you saw there's some huge charge. Why did they charge you this huge dollar amount, but then you saw that they credit it on the closing disclosure? It's because it's rolled into the loan amount. So to get rid of MIP, you can get rid of the first one, the monthly, but there's no way you're going to get rid of the second one. Okay? The second one, when you do pay off that loan, that mortgage insurance premium will be paid off as well. Okay? So understand there's two types. One of them, that's what we're going to focus our energy on how to remove. And the second one, it's already rolled into the loan. So when you buy a home with an FHA loan, you put 3.5% down. They tack back on 1.75 mortgage insurance premium for the upfront. Okay? So now that we know that, how do you get rid of MIP? That is a question I see in my messenger all the time. So there's two ways to get rid of MIP. Automatically, that means it falls off automatically as you make your payments over time. And number two, refinancing. You are changing the terms of your current loan to remove your mortgage insurance premium. Okay? So let's talk about automatically first. That's what everyone wants to hear. Everyone's crossing their fingers. They have a low FHA rate. They got FHA. They didn't go conventional, and they forgot. Hey, thanks for this low interest rate, but how about this mortgage insurance premium? Is it permanent, or will it fall off automatically like it does on conventional? So there is a way that it falls off automatically. Got your pen and paper? Let's take some notes. So for it to fall off automatically, you have to put 10% down when you bought your home with the FHA loan. That means the initial down payment, not 3.5% down, not 5% down, but 10% down on the purchase. So if you bought a home with an FHA loan with 10% down, on the 11th year, your mortgage insurance premium by Felicia will fall off automatically. Okay, it's the only way it falls off automatically in a purchase. You bought it 10% down on the 11th year without refinancing, calling the servicer, doing appraisal, it will fall off automatically. The second way it falls off automatically on an FHA loan is if you did a cash out FHA refinance. Especially right now, we have tons of equity. Rates are up right now. A lot of people are doing cash out refinances. What they're doing is they either have a conventional loan and they have tons of debt. For some reason, they can't go conventional. They go FHA. If they go FHA, they put the MIP back on. Or if they had an FHA loan, they have tons of equity and they have to do a full FHA cash out refinance that requires an appraisal. They have MIP again. But on the 11th year, the MIP will fall off. So if you have an FHA loan and you did a cash out refinance, you're at 80% loan to value. That means you have 20% equity. I have 20% equity. Why should I have MIP? There's a reason why you had to go FHA. Because of that risk, they want you to have MIP for 10 years, okay? No, it's for 11th year. And on that 11th year, your MIP will fall off. So those are two reasons, or the two ways MIP will automatically fall off on an FHA loan. Number one, if you put 10% down on the purchase on the 11th year, it will automatically fall off. Or if you have a cash out refinance FHA loan on the 11th year, the MIP will fall off. But if you did an FHA streamline, the MIP will not fall off because you did not do an appraisal. An appraisal acknowledges your equity position. And with that equity position, it tells FHA your risk and should MIP fall off automatically. Remember, purchase 10% down or more, FHA cash out, right? Not streamline. Hopefully that helps you understand when MIP will fall off on an FHA loan, okay? Now, let's talk about refinancing it. Should you refinance out of an FHA loan? That you definitely need to talk to your lender. Make sure it makes sense. Remember, typically FHA loans have lower interest rates than conventional loans. So times may change where rates have gone up, and it might be worth keeping your FHA loan with the MIP instead of refinancing it from FHA to conventional, even if you remove the MIP. Not always always a circumstance. Definitely talk to your lender. I see a lot of people get excited about removing MIP, and when they get into the process, they realize the payment really didn't change, and they ate up equity with the cost of refinancing when they should have just left their loan alone until rates got better. So don't be in a rush. I just wanted to add that, right? I'm all about making money, but I'm not all about making money that it's gonna cause a result of hurting someone else or eating up someone else's equity. If you're a loan officer, you're doing that, phooey on you. Okay, let's get back to it. FHA, right? Must refinance from FHA to conventional. That's the only way to do it if you do not put your 10% down, okay? You have to refinance from FHA to conventional to remove your MIP. So let's start with your standard 20% equity. If you bought a home, after 6 months, you can use the new appraised value on a conventional loan to remove MIP. If you have 20% equity, anytime after 6 months, you can refinance from FHA to conventional and remove your MIP with your 20% equity. So if that is the case and your payment actually drops if you do the refinance, definitely it's a good look. Do it, okay? So what happens if you don't have 20% equity? Everyone assumes because we gained so much equity in the past year, 2 years that you have the 20% equity. Not in all cases. In a lot, yes, but not all. So if you go to your lender and you're trying to refinance, Mr. or Mrs. Lender, I want to refi, I have an FHA loan, I have tons of equity. Go ahead and do the refinance. If they do the appraisal and you don't have 20% equity and rates are low, this is what you can do. You can do temporary PMI, lender paid temporary, not MIP anymore. So this is going to go conventional. It's called PMI. Government loans is called MIP. Conventional loan is called PMI. You can get temporary PMI, lender paid PMI, and single premium PMI if you don't have the 20% equity. Okay, I'm going to break it down for you, of course. Let's talk about temporarily PMI. Let me read the slide here to you. You still make monthly PMI payments until you pay down the house 20% from the original purchase price before you can request the PMI to be removed. If you have 3 to 9% equity, when you refinance from FHA to conventional, you must wait at least 2 years and have 25% equity after refinancing to request the PMI to be removed. if you have 10 to 19% equity when you refinance from FHA to conventional. A lot of rules have changed. Depending on the lender, you may have to wait at least 1 year and have 20 to 25% equity before you can request for the PMI to be removed. So if you want to go with a temporary PMI, it has a lower rate than some of the other programs out there. When you go from FHA to conventional and you don't have the 20%, temporary PMI is good. That means, let's say if rates don't improve, you refinance from FHA to conventional. In time, your PMI will fall off on a conventional. And we gave you the reasons why and how it falls off. So that's temporary PMI. Now let's talk about lender paid PMI. The rate is a little bit higher, but you don't have monthly private mortgage insurance. So there's no PMI payment to make. So you might be saving some money here, even though the rate is higher than the temporary monthly and on the single premium, which we'll go over in a second. Lender paid PMI is when you take a higher rate and they cover, in the higher rate, you cover your mortgage insurance, your PMI, okay? So the lender is giving you a higher interest rate, but they're rolling the PMI into the interest rate and they're making that payment for you. So if you go from FHA to conventional and you have 3 to 4.99% equity, you're probably going to have a pretty high rate. If the lender does your appraisal and you have 5% to almost 10% equity, the rate's still high. You want it to have at least 10 to almost 15% equity. You'll have a better rate. But if you go from FHA to conventional and you don't have the 20% equity, but you got 15% to almost 20% equity, that's when you're going to get the cheapest lender paid PMI rate. And I recommend this if you have a 720 credit score or better. If you don't, the rate might be a little high, okay? So we talked about temporary private mortgage insurance, lender paid, right? Lender paid is a great option if you're like, you know what, I don't want to trip over PMI. I'd rather just do lender paid and not see that payment. Remember, the higher the interest rate is also tax deductible. Mortgage interest is tax deductible. PMI is not tax deductible after 2021, okay? So great options if you don't have 20% equity. And our third option to get rid of mortgage insurance premium, right? I get mixed up myself. The third option to get rid of mortgage insurance premium, if you don't have the 20% equity, when you go from FHA to conventional, single premium mortgage insurance. You pay the insurance premium up front, okay? So on a $500,000 loan, this loan, not purchase price, loan, the cost is between 1 to 2% of the loan amount. So it can be between $5,000 to $10,000, depending on your equity and your credit. I do recommend, again, you have a 720 credit score or better if you're going to do single premium. The reason why I like single premium gives you the same rate as temporary PMI rate. It's a lower rate than the lender paid, okay? So what happens if rates don't get better? At least you got the lower rate with single premium. Let's say rate values don't go up. You're going to have to pay, if values don't go up, you're going to be stuck paying temporary PMI for a while till you pay it down, right? Single PMI, you get rid of it and you don't have to think about it. It all depends on your equity level and, you know, what you decide you want to do. Everyone has a different strategy on how they want to continue on with their mortgage. I'm letting you know, single premium is my favorite. We did it on our house. We bought our home 10% down, single premium. Now we don't know where values are going to be. We were so close to 20% equity, but we're not sitting here checking, you know, reports every day. Oh, do I have 20% equity? Right? We just paid it at once. Not everyone has that opportunity. We did, so that's what we did. Okay, let's get back to it. So if you go from FHA to conventional and you have between 3 to almost 5% equity, the rate's going to be kind of high, probably close to the 2% cost. So on 500 grand, that's 10 grand. You can either increase the loan amount if there's enough equity to pay it or come out of pocket. It's up to you. Okay. Also, if you have 5 to almost 10%, you'll still have a high rate, but you have 10 to almost 15% equity, that single premium is cheap. If you have 15, close to 15 to almost 20%, it's the cheapest. So if you go from FHA to conventional and they bust your they bust your bubble and they say, hey, what?
Your video's frozen.
For some reason, why is it frozen? Is it all right now? Are we good? Guys, can you still hear me? Oh my goodness. Are we good now?
We are good now.
All right, let's go back to it. Okay, sorry about that, guys. So If you have single, so single, where they cut off?
Just redo this.
Okay, go. All right, guys. Apologize. Let me explain single premium one last time. My favorite way to get rid of PMI, if you have to go from FHA to conventional and you don't have the 20% equity, is single premium mortgage insurance. You pay it, the insurance premium, you pay the insurance premium upfront one time. So if you have a $500,000 loan amount, not purchase price, it can cost you between 1 to 2% of the loan amount, depending on your credit and your level of equity. So it can be between $5,000 to $10,000 on a $500,000 loan amount. I do recommend you have a 720 credit score or better. Let's say you try to refinance from FHA to conventional, thinking that you have 20% equity. If you have between 3 to 5% equity, the buyouts can be kind of high. That's the truth, almost 2%. If you have between 5 to almost 10%, it's still kind of high. But if they check your value and you have between 10 to 15, the buying out the PMI will be pretty affordable. But if you have between 15, close to 20, it is the cheapest. So if you get a chance to get rid of your mortgage insurance and you have 15% equity or more, I would definitely do it. 10% or more, I would definitely do it as well. Between 3 to 10, it all depends on where you feel like the market is going. It might be worth it, it might not. But to me, it's my favorite pound for pound. Okay, so that right there, fam, is how you get rid of mortgage insurance premium on an FHA loan. Okay, remember, there's two types. There's upfront and there's monthly. Upfront, you cannot get rid of. It's already rolled into the loan amount. When you refinance out of it, you're going to pay it off anyways. Okay, and now monthly, there's automatic and there's refinancing. Automatic, remember, you got to make sure you put 10% down when you bought the home, and on the 11th year, it falls off. If you did an FHA cash out on the 11th year, that MIP will fall off as well. Now refinancing, right? If you have 20% equity, great. You can refinance from FHA to conventional after 6 months of owning your home and get rid of the MIP if you do have the 20% equity. But if you don't, remember, the three ways: the temporarily, where you go FHA to conventional. Once you pay down your house to a certain dollar amount, or you gain specifically a good amount of equity, you can remove your MIP, okay? Or we can do lender paid, where it's rolled into the rate, or single premium, which I like. You cover it all at one time. You don't have to worry about it. But fam, that's how you get rid of mortgage insurance premium on an FHA loan. Hopefully this video brings you a lot of value, or brings value to someone that you know that has an FHA loan. Please save this video and share this video. And if you are not following me by now, by the time you made it this part of the video, phooey on you. I'm kidding. Please hit the subscribe or notification button so you're notified every time we go live or post new content. All right, guys. Also, if you have more questions, hey, should I do or should I not do it? Give us a call, 714-790-9697. Or you can DM us or message us or email us, info@whatsamortgage.com. And don't forget one last thing, follow us on our other platforms on Facebook, YouTube, Instagram, TikTok, and LinkedIn. All right, guys, let's go with some Q&A here. You got all that? How was it today? Good? What's going on, Jolene, Miranda, Myra? Does the buyer have the option of selecting which mortgage insurance that works best for buyers? On an FHA loan, no. On a conventional loan, yes, Myra. Conventional, you have options of temporarily PMI, lender paid, or single premium, okay? Or they have something called split as well, which I rarely see anyone get. Jolene, what is the difference between FHA and conventional? There's a lot of difference, Joe. There's a lot of differences. I don't know what you're looking for, but on an FHA loan, they're more flexible when it comes to qualifying with credit and debt to income ratio than conventional. FHA, because they're more flexible, there's mortgage insurance premium, there's upfront and there's monthly that you got to pay. But because they're flexible, they are taking a bigger risk. That's why they have the MIP. On conventional, they're taking lower risk. That's why you're going conventional, and that's why the PMI can fall off automatically. There's more flexibility on what type of PMI to get as well. That's the big difference between FHA and conventional. FHA, more flexible to getting the loan, but stricter on getting rid of the insurance that they give you, because they are taking a risk on you. Hopefully that helps you out. Fernando, once I get the MIP removed, can I get money back from what I paid all that time? I bought in 2017 and refinanced in 2022 and removing PMI altogether and cashing out too. No, Fernando, there is no refund on the MIP. Hopefully that helps you out. Oscar Brenda Guzman, are there any zero down FHA programs? Yes, there is. So all these 100% finance, these down payment assistance, 100% financing programs, you are still coming out of pocket. Okay, so there's programs out there like NACA. There's programs out there like NACA, GSFA, Chinoya, CalHFA. Majority states have down payment assistance. Chinoya is a nationwide program. I'm in California. We focus on GSFA and CalHFA. Hopefully that helps you out. And NACA is also nationwide, but it's really hard to get a NACA loan approved by a seller because they're taking a while to close. Hopefully that helps you out. I got approved in January for a home, but decided to pay off my car loan and go in with a down payment. Good choice or no thoughts. So if you pay off your car and you go with going in with let's see, I got approved in January for a home, but decided to pay off my car loan and go in with a down payment. Good choice or no? To me, I would see where I qualify first, because if you pay off that car and now you're saving money, by the time you save the money, the monthly payment on that home will be a lot higher. But I get it. If you have to pay off the car to qualify, you got to do what you got to do. But when you pay off the car and you don't have the funds right away, and by the time you save it, you might be priced out of the market. Talk to a lender to make sure you have a good game plan. Hopefully that helps you out. Jason, I love FHA Streamline Refinance Program. I did it twice. Now my FHA rate is 2.25. There's no sense refinancing to conventional when I got a low rate, man. Low rate, man. Is it true that the equivalent rate of FHA is? I can't say. It all depends when they got their FHA loan. There's also time as well. So if you have 2.25, Jason, that is a good deal. The reason why, when you make your mortgage payment, you're paying more principal than interest sooner than someone else with a conventional loan without PMI. So it is a good deal, but just know that PMI is permanent. So I like what you're doing. I think it's good, especially if your loan amount is like under 400,000. It's cool. You know why? Because your MIP is not that expensive. Of course, if you're in the 600,000, 700,000, 800,000 FHA loan, even though rates are higher on conventional because the MIP is so expensive on a higher loan amount, it still might be worth refinancing to get rid of your MIP. It all depends on the situation. But Jason, if your loan amount is under 400,000, I think it's a good deal. Hopefully that helps you out. Thank you, Jose, for letting me know that. We can hear you. Thank you, Myra. Thank you. Credit score to go conventional. Rose Alagua. So if you want to go conventional and you go 5% down or more, a 720, 700 credit score is solid. But if you're going to go with 3% down, you want to have at least a 720, 740 if you want your payment to be better than FHA. Hopefully that helps you out. Jolene, what's going on? Does FHA require reserves? Imelda, it all depends. If you have above a 660 credit score, FHA will not require reserves. Under 660, if your DTI is too high, the automated underwriting might want you to have reserves. If you are buying units, you got to have reserves for your other units. But if you have under a 620 for sure, most likely you're going to need some reserves. Hopefully that helps you out. Rose, FHA, are you able to pay PMI upfront? No, you cannot do that on FHA. You can pay off the upfront PMI, but you can't do the single premium. On FHA, you can pay the upfront PMI off, but you'll still have monthly. But you can't do partial. If you're going to pay the upfront PMI, you got to pay it all off at one time. Hopefully that helps you out. Not really a related question, but should I pay my property taxes upfront or have them rolled into my payment? Sydney, that all depends on if you're disciplined. Okay. Myself and my family, we pay our property taxes and hazard insurance in one payment. We just don't want to think about it twice a year. All right. Hopefully that helps you out. There's no difference. You're going to save a little interest by you're not saving interest, but you are if you're keeping the money in your bank account, but it's not really that much of it's not that big of a difference. Thank you, Sherry. Thank you, Imelda. Hopefully this information helps you guys out. Guys, I appreciate everyone who watched tonight. Thank you for everyone who saved this video, share this video, and like this video. All right, guys, we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much and have a great night.